The world is failing to meet the unprecedented challenges of our time because it is embroiled in a vicious cycle of distrust, according to the latest Edelman Global Trust Barometer. Let's talk more about this with Edelman CEO Richard Edelman. Richard, always nice to see you. Within this report, you're saying that distrust is now society's default emotion. Is that mostly because of the pandemic, or there's something else going on here?
I think the pandemic has actually worsened the situation, but we have some fears that really are core, which is downward economic mobility, fear of job loss to automation, sustainability, climate change, privacy. But what the pandemic has done is fundamentally weakened our belief in government. This is in the democracies. Democracies are really declining. And what you see is evidence that business has to step into the void. 5 times more trust in business than in government on a matter of competence, 50 points. It's crazy. And again, the pandemic is the shop window that people are using to evaluate government.
Richard, it's Julie here. At the same time, this is a trend that's been going on for a couple of years now. I've been tracking your survey. Of course, we've talked about it before. And that confidence in business has been rising. And we have seen this trend of businesses feeling they had to step in to try to solve some of the world's big problems. Now, your firm counsels these guys, right? Is it a blessing and a curse? What are the sort of pitfalls of being seen, of being held in higher esteem and being sort of given greater responsibility on that front?
So it's a left hand and right hand, Julie. So on the positive side, by 5 to 1, people say, I want more business involvement on climate change or race and diversity or reskilling. But at the same time, for the first time, we find that there's a big drop in trust in business by Republicans who feel that business has gone too far. 12-point drop. First time we've ever seen Republicans trust business less than Democrats. So in fact, you have to have a swim lane. And to just say, okay, business, you take it all, is a mistake. Business wasn't elected, it wasn't appointed, and we have to be sure that there's a playing field established by government such that stakeholders see that, in fact, business is executing within its remit.
But Richard, you also assigned some blame, or the survey assigned some blame to the media. Take us through that.
Well, I think that government and media are in a death grip. The business model for media at the moment is move to the extremes, generate heat by controversy, and that leads you to more subscriptions and rinse and repeat. And on the other side, the government is aiming at division and makes its business somehow of fundraising improved by controversy. And so these two institutions, which should be the most normal, logical, stabilizing force, have actually forfeited that. And it has to be business that acts as the stabilizer in the next year or two.
Do you see these percentages in terms of degrees of confidence? Do you see them coming back to more normal levels, or is this a change that is going to be more permanent?
I think government has the best opportunity to recover. We saw, in fact, at the beginning of the pandemic that government was 65% trusted, the only institution with a big enough bazooka to handle the problem, biggest since World War II. But how we handle the pandemic in the next months is going to be the key to reestablishing trust in government. Meanwhile, for the media, it has to be make your business about authority again, as opposed to chasing clicks. If, in fact, we are going to have a successful world, information quality has to improve so that we actually have a set of agreed facts and we can make decisions in everybody's interest.
Richard, lastly, were you surprised that in the barometer that many said they think they will be worse off financially in 5 years?
Look, I think it's a problem of democracies. We saw that no democracy actually had over 40% belief that they would be better off in 5 years. And similarly, 80+% worry that they're going to lose their jobs to a machine. So until we solve those core problems, we're going to have a trust deficit in democracies, in government. Also, the mass class divide is stunning. It is now between the highest and lowest class, 25%, bottom 25%, we see a huge divide. And again, it's because assets have gone up in value for the wealthier class, and the lowest 25% doesn't have access to those. So we've got to make sure that there's a fair solution for all. The system has to work. That's the key point.
All right, we'll leave it there. Edelman CEO Richard Edelman, always nice to see you and catch up with you on this. We'll talk to you soon.
Let's take a deeper dive in some of those moves Jared just highlighted. We've got Troy Gajewski, FS Investments Chief Market Strategist. Troy, it's always good to have you on the show. You've sort of, said this is expecting that last year was the green light year. This year, we're kind of going into a yellow light, things slowing down. And here we are talking about these big moves to the upside with bond yields. What does that tell you about how cautious investors are now turning, especially with those rate hikes looming?
Yeah, so it's really interesting to see markets digest this transition from green light go to yellow light caution. And remember, all the Fed's really done so far is slow down the pace of their bond purchases. They've actually yet to hike at all, as you know. And so what you've seen, of course, is fairly mild correction so far. You've seen some degree of pain and go-go growth. But in general, we think it's going to be a rocky year, right? And that's one of the main reasons why we see clients focused on the challenges, not only for the fixed income portion of their portfolio, which has been a really problematic place to be really since the summer of 2020, but finally, again, on the equity part of their portfolio, where, I think the best you can hope for this year is no multiple compression. With reasonable earnings growth, but more than likely, you'll probably get 2 to 3 turns of multiple compression with, call it, 10 to 15% earnings growth. And so it's just a much different environment than we've been we've been in since the pandemic bottom.
Of course, one of the rosier areas that many investors had leaned into for many years to this point, especially in the bull market period, has been tech. And so with that in mind and the potential for raising rates as much as some of the bank earnings and the bank CEOs have projected, what does that set up for tech, especially as we go into some of that heavy rate concern and headwind?
Yeah, so I think from an asset allocation standpoint, obviously you want to fade 60-40 in favor of alternatives, whether it's senior secured commercial real estate or multi-strategy or CLO double Bs. But from a standpoint of tactical asset allocation and sector focus, this is a time where you want to lean into cyclical and value, where you have less potential for multiple compression, and want to, at least on the margin, fade tech. Now, particularly the go-go growth stories of 2020, which, as you know, in many cases are down 30, 40, 50% already. Those very difficult, if not impossible, to time a bottom. So within the market itself, time to rotate a little bit away from large cap tech, where you would expect more multiple compression, into more value cyclical opportunities. And it's actually interesting you guys were bringing up oil before, because oil is obviously benefiting from tremendous supply constraints with burgeoning demand as the real economy continues to pick up. And that's one of the areas that we're cyclically focused on because, basically, if you think of the commodity complex, there's been underinvestment in energy production now for the last year and a half, and it's unlikely that changes. So as you continue to get reopening of the economy, that's one of the sectors that should at least modestly outperform the broader market.
Yeah, how much more runway do you see on that front, though? If we're talking about oil moves specifically, we've heard some calls for $100 a barrel. Obviously, energy names have gone up alongside those expectations. Is this more of a short-term play here, or you think there's a bit more room to run?
Yeah, so I think the best way to think about it is there's a higher floor under the entire commodity complex because of the lack of investment. In oil, it's been more recent, but in commodities and iron ore, it's been going for 6-7 years. So you can have confidence that the floors are higher. And in the near term, as long as the dollar doesn't strengthen dramatically, the trend is your friend there. So you continue to see modest upside. But no one's talking about $150 barrel oil, but you could certainly make a run at 100 over the next 3 to 6 months.
Okay, and so we got to switch gears here. We got to bring Bitcoin into the chat and some of the thinking around how, this all sets up for going forward from here, and what particularly you're tracking on how Bitcoin is setting itself up for some supply shock. Break that down for us.
Yeah, so in the short term, we would certainly favor higher risk reward opportunities like in senior secured commercial real estate or liquid multi-strategy or some of the areas of corporate credit where you have higher yield with some price appreciation potential like double B CLOs. But within crypto particularly, the thing to remember is just like all growth stocks, it is more challenged in an environment of less money supply growth. That was one of the principal reasons for its meteoric appreciation starting in 2020. And so as that slows, gains would be harder. Furthermore, we're also fairly late in the halving cycle, right? This has already been the longest halving cycle bull market period. We peaked out obviously late last year. So our message to investors there is pretty straightforward. You really shouldn't be owning Bitcoin or crypto for the next month, 3 months, or 6 months. You should own it because it's one of the principal ways that you're hedging continued government profligacy. Meaning over the next 3, 5, 7, 10 years, do you continue to expect large budget deficits? Do you continue to expect more money supply growth than we've had in previous cycles? And if the answer is yes, then you should at least have some portion of your portfolio there. That being said, we do expect continued chop. It's an uncertain environment, and it's basically a tug of war between continued adoption, not only by institutions, but ultra high net worth individuals, not just in the US, but globally, and the natural dynamics of the halving cycle, and obviously a Fed that's tightening before our eyes.
So Troy, if it is about a hedge, how should investors be looking at this? Are we talking about 1% exposure, 5%? I mean, what's the risk? I mean, I guess it depends on somebody's risk tolerance, but what are you telling clients?
No, so, and again, remember the hedge is a hedge against government profligacy, not against negative market price action. That always gets confused by people. Like whenever you have a big drawdown in broader markets, you should expect crypto to sell off in tandem. Now, sometimes it does, sometimes it doesn't. What we're talking about here is more medium to long term, where if you look at your asset allocation, you threw out numbers like 1%, maybe it's 50 basis points. If you have a higher risk tolerance, maybe it's as high as 5 if you're a younger person, like yourself. But you have to understand that this is a very cyclical, volatile asset. And so you could wake up any day and be down 20 to 30%. If that changes your frame of mind, if that causes you distress, then you should have a smaller allocation. But it's important, just like with gold and real estate and other assets, that you have some assets in your portfolio that will benefit from continued government profligacy, like we've really seen over the last 20 years plus, starting with the Greenspan era, right? Most investors are much more aware now of what's gone on with monetary policy since the pandemic bottom. But they're less aware that this is a continuation of these mega trends where it requires more and more money supply to generate less and less GDP and larger deficits. So, I think you're in the right zip code, right? And this ultimately comes down to people's risk tolerance, where they are in their life, how comfortable are they experiencing, large drawdowns in order to have material upside. And then again, if you step back even further, it's one of the few assets that still has the ability to double or triple over a medium to longer term time horizon. Whereas if you look at the NASDAQ as an example, everyone expects a chop year this year, we think, and if they don't, then obviously they've got a rude surprise. But over the medium to long term, it's going to take a lot for the NASDAQ to double from here, whereas with Bitcoin, you could certainly see that happening in 2024, 2025.
All right, a lot of big price targets out there for Bitcoin as to where we will hit at the end of this year and even going out to 2025. Troy, we're going to trek back in the future. That's Troy Gayeski, who is the Chief Market Strategist over at FS Investment.
Zoom is hosting its first Work Transformation Summit, where industry leaders will gather and bat around ideas for the future of work. For its part, Zoom remains in remote work mode during the pandemic, but will likely move to a hybrid model post-pandemic. Let's talk more about this with Zoom CFO Kelly Steckelberg. Kelly, always nice to see you. Thanks for joining us. Help us think about this future of work. Does the physical office play any real role as we start to move beyond the pandemic?
Yeah. Hi, good morning, Brian. It's really interesting because work is evolving from historically have been a place to now being a space where we come together. And what we heard from our employees is they want to gather and they want to be in a physical proximity together to collaborate, to socialize, and to see their colleagues but not necessarily to get their work done on a daily basis. So we are announcing our work styles. And this is after a long time of listening to our employees, talking to them about what's really important to them. And there's going to be 3 work styles that we're going to have at Zoom. The first and the largest population will be hybrid, as you said. They will have the flexibility to come to the office on a periodic basis. For some individuals or some teams, that might be a couple days a week. Others, it might be a couple days a month. And these are largely employees that live within a commutable distance to one of our offices. We will have a sizable portion of our employee base that will be fully remote. So these are employees that either were hired into a remote position initially, or during the last 2 years have moved beyond a commutable distance. I'm a perfect example of that. I have left the Bay Area and now living in Central Texas. And then the third and really smallest population of our team will be individuals that are in person. They do have in-person roles, but these are based on the roles and responsibility of it. They are people like our workplace team that are taking care of our physical spaces, as well as our IT organization that are managing servers or other supplies in the offices for us.
Kelly, I've had some friends recently try to go back to the office. They've navigated that pretty well, but they still have meetings and they walk into a conference room and they still don't know how to act. Map this out for us. What does that conference room experience of the future look like?
This is such a great point, Brian. Like having the right technology and strategy around your conference room solution, both hardware and software, is imperative to having a successful office reopening program. And Zoom has been working very closely with our customers and innovating around this. And there's a couple of key innovations that we're really excited are part of our Zoom rooms. One of those is Smart Gallery. So those of us that have been working remote for a long time, we've all become very accustomed to this experience where we can see everybody's face on the screen. We can see their names. We can tell who's talking very easily. And you lose some of that when you have some employees working in a conference room together and some that are remote. What Smart Gallery does is it recreates this experience by having a view of the room, but also having an individual view on every person that's in that conference room. So if I'm the person that's not there, I still have a really clear view of everyone who's there. I can be, included in the discussion in a very easy way because I can see everybody. I can see their reactions on their faces. And that's one of the innovations that we've done. We've also done something called companion mode, because we've heard from many people that the other benefits you get from a Zoom meeting is things like the chat functionality, the ability to participate in polling, and companion mode gives you that when you walk into a conference room, you can join a meeting silently from your laptop or your mobile device, and then still have those features, but you join with your camera and your mic off so it's not disruptive, but you get to participate fully in the meeting.
Hey, Kelly, it's Julie here. So I'm curious, as you've been working at home and as you've surveyed your employees, like what was the most sort of head exploding moment for you? I guess I mean that in a good way, meaning like what was the most revelatory for you in terms of what people were saying or what you were experiencing that you didn't sort of expect from the at-home experience?
I think there's 3 things. I think, first of all, 85% of not only our employees, but we did a survey recently with Momentum, and 85% of employees that are currently working remotely say that it's most important that they get to choose. So having choice, the employee having choice is the most important thing for them. And so we want to ensure that our employees get just that. And that's what our work styles are defined for. Also, only 1% of Zoom employees said they wanted to be in the office full time. We're going to end up with about 2%, but that's based on the roles that they have and those responsibilities. And then last but not least, which I found so interesting, is our employees, they miss their colleagues. They want to come together. But the top 3 reasons people wanted to be in the office, it was really around that. It was like around socialization and collaboration, because we have all adapted so well to getting our work done remotely. We don't need to be in the office any longer to accomplish that, but we can benefit from other aspects like seeing our friends and colleagues.
And so do you anticipate that you guys will do, as you said, it's going to eventually probably be some kind of hybrid model. How do you sort of organize for people to come into the office and have that social aspect and still, kind of logistically, how do you get that all done?
Yeah, so the way that we're thinking about it is a couple things. First of all, we are opening our offices and testing and learning and experimenting. We know that we all knew how to work together when we were all in the office. We've all learned how to work together remotely. And now we're going to have to all learn how to work together in a hybrid environment. So we are doing a couple of things. First of all, we will have a way that employees can reserve a desk so that you'll be able to go on and see, like I can look the night before and see like, hey, my team will be in the office tomorrow. I would like to join them. So you can plan accordingly. We also will encourage managers and teams to self-organize. It's not going to be programmed by the company, but self-organize around days in the office that might work best for them. So for example, my team, maybe finance and workplace, Tuesdays and Thursdays are the days that generally we come to the office if it works for people. And then the other thing is that employees will have the opportunity to work with our people experience team, especially our managers, to learn how to manage in this environment. It's a very different experience, and we want to ensure that everyone is empowered and able to have an inclusive opportunity and experience, and that's what we'll provide to our managers to make sure that they feel supported in this experience.
Well, good luck at the summit today. Zoom CFO Kelly Steckelberg. We'll talk to you soon about earnings coming up.
Sounds great. Thank you, guys.
When he's not crushing the competition as a defensive tackle with the Super Bowl champion Tampa Bay Buccaneers, Ndamukong Suh is busy scoring with his portfolio of investments. We are delighted to have this NFL star and five-time Pro Bowler with us today. Ndamukong, thanks so much for being here. Look, we'll get to football in a moment, but I know you have been for a long time an investor in the restaurant and hospitality industry, and you recently tweeted out some information that's getting a lot of attention. You said it's never been this bad for the restaurant industry. Tell us what you're seeing with regards to the restaurants you're involved in and what needs to be done right now to help the industry.
Yeah, it's been very, very difficult. And unfortunately, we've been in this pandemic for close to almost 2 years now and counting. And I think as we understand the restaurant business is a livelihood of a lot of many people, whether it's people working in the service industry or actually the cooks or the farmers. And it's important for us to understand that we got to continue to support our community. And I've been fortunate enough to be in the hospitality space since I first got out of college. Blue Sushi was a great restaurant I went to when I was a kid in college, and I wanted to be a part of it. So I asked the owners, and we've been able to create some great restaurants in and around Lincoln University of Nebraska.
Mr. Thanks so much for joining us. This is Karina Mitchell. So happy to have you on. Wondering, what do you say to consumers who really want to help restaurants, but they are so afraid of this Omicron variant that perhaps they're not going out so much? And then because you are so involved in the industry, what are you hearing from restaurants as far as consumer behavior? Are they tipping well? Are they behaving well in the restaurants when it comes to mandates and vaccines?
Yeah, I think it depends on the part of the country that you're in. I'm in Florida and obviously have restaurants in Portland, Oregon as well. And really it comes down to people being courteous and understanding everybody's particular wishes when it comes to the COVID regulations and mandates. But I think the biggest thing people can do is start in their community and go out there and support the restaurants they've loved and they've enjoyed, and not be afraid to try new restaurants and really take it to go if you don't want to dine in or there's not an option to dine in. And I think that's important for folks to do because there's a trickle down effect. As I mentioned before, there's the farmers, there's wineries, there's distilleries, and really being from Portland, Oregon, that is one big place that we strive to be very elite in the agricultural world, and so it has a big effect.
I want to talk about your overall investment portfolio because it's quite wide ranging. What else are you investing in right now? I know there's some real estate in there. Are you playing with NFTs and crypto to any extent?
Yeah, so real estate has always been something I've learned and really from my parents, cutting lawns as a little kid to help be a part of that overall success of having apartments, and then really having that additional generational income to be able to help me support to go play sports and travel. I have dibbled and dabbled a little bit in the NFT and crypto space. Most notably, Metaplex was a recent investment that I just did along the Solana blockchain. And it's been exciting to be a part of these things and really learn. And that's where I want to do as a young man, know my career is probably coming to an end, me being 35. They consider me a very old man in this game, but I have great aspirations to be more successful off the field than I was on the field.
And one of your aspirational people that you speak to is Warren Buffett. I know he's given you advice in the past and suggests, maybe taking advantage and buying the dip. So, we saw the NASDAQ in correction territory yesterday. I wonder if there may be some buying opportunities and things that you are interested in looking at.
Yeah, there's some opportunities, and you definitely want to do buy in the dip and find things that have great intrinsic value, as I've learned from him. But also at the same time, just being able to know you have strong companies you've invested in, and it's all about being patient. That's one of the best tools I've ever learned from him. It's about being patient, understanding that this company you believe in has strong roots. It's going to have to weather the storm, but most likely, if it's a very strong company, it'll come out better on the other side. Excuse me.
So Warren Buffett is a mentor of yours, but you've become a mentor for many young athletes coming up. We've seen this story before. They come into a lot of money early on and wind up losing it. What's a good way for them to build generational wealth, especially since, a career in something like the NFL doesn't last very long?
Yeah, the career in the NFL is on average 3.5 years, and I've always understood that. And so that's one of the reasons why I got my engineering degree and then focused in real estate, and also had the opportunity to have a father that was an engineer as well as a mother that was a school teacher that always instilled that education is one of the most important things that nobody can ever take from you. So with that being said, I'd always want to find mentors and people that I've been able to understand how they've created success and follow in their footsteps, and then create my own focus on how I wanted my life to look at when I decided to retire. So it was exciting for me to be able to have those opportunities, and the NFL opened up a lot of them even much more. And so for me, advice for young players and young people in general is just go out there, don't be afraid to ask questions, be hungry, and focus on things that you care about, and make the most of it.
And Ndamukong, I want to turn things over to what you're doing on the field. You were with the Buccaneers last year. I'm wondering, how different is it this year playing? Obviously, you have Tom Brady on the team as well. Wondering what that dynamic is like. And what would a second Super Bowl ring mean to you personally?
Well, I mean, we were the underdogs last year, and we came in 5th seed, and really people didn't really care for us to think that we had an opportunity to win a championship, and we proved them wrong. And so the roles have really reversed. Now we're in the Kansas City spot where they were last year, being the previous Super Bowl champ, and people are targeting us. And we have a big opponent against the Rams this weekend at home that we need to make sure we take care of business to get our goals to being back in Super Bowl and actually heading to LA to play in the Super Bowl. So that's exciting. I think we have a great team. We've dealt with the injury bug. Guys are starting to come back. I'm excited to where our defense is trending in the right direction. And really, to answer your other question of winning a Super Bowl, I've got twin boys, so I need another ring for my other son so they don't have to share.
I love it. That's great. And also, when you say your career may be ending soon, folks are talking to you about a future, you being a future Hall of Famer. When you think about your legacy and what you want to leave your boys, both on and off the field, what is that?
I think the most important thing is when it comes to being on the field, it's about dedication, hard work, and being a champion. I think that's one of the things that I've been able to be very, very steady and very lucky to be successful on the field. But when it comes to being off the field, it's just about being strong young Black men that have changed and being thought leaders and being able to be an example for other people and help them grow. And that's something that I aspire to help them be, as very strong men that understand that they can make a lot of different change, and they don't have to do it via sports. They can do it in any particular way they choose to, as long as they're passionate about it.
And obviously, you have this big game coming up on Saturday. I know nothing about football, so I have no dong in the game. So I have no problem wishing you all the luck and hope you guys take it all the way to the end again. But I am wondering, what challenges has the team had to face dealing with Omicron, and how well do you think the league has handled making sure the players are safe and then bringing back fans into the seats this year?
Yeah, it's been a huge challenge, and it started all last year where we were tested each and every single day. The rules and regulations have changed and been fluid throughout this particular season, and something each and every individual needs to take into consideration of how they want to particularly move forward. And then, really, for our own team that I can really speak for, we've done a great job. I think we've had some cases where we've been in, potentially issues going into games. But I think overall, guys have been cautious in respecting people's wishes and how they want to do it, masking up and doing the different things that they feel is necessary for them to be safe and be ready for the games, but also respecting everybody in the locker room.
Real quick, that big game's just in 3 days. In addition to being on Yahoo Finance, how do you prepare for a big game like that with just, hours to go?
Oh, to be honest with you, it's being able to compartmentalize, and I love to get away and being able to do these fun things and be able to have you guys have me on Yahoo Finance and have great conversations, because it keeps me sharp. It allows me to dive into football, but dive into things that I care about in the world, whether it's restaurants or real estate, and being very sharp. And I think that's something people don't really know, that athletes like to get away at times from sports, to not be just fully dived into them, even though we're very focused and ready for the game time. And I'll be for sure ready at 3:00. This is my former team in LA. I actually lost the Super Bowl with them a couple of years ago. So we'll go from there.
All right. And Ndamukong Suh, we know you're going to have your game face on come Sunday. Best of luck to you and to the Buccaneers. Thanks for being with us.
Netflix having the biggest single-day tumble going back to October of 2014, following subscriber growth that is lackluster versus what the company itself had been predicting, not to mention the street. Let's get Rich Greenfield's take, shall we? He's partner media and tech analyst at Lightshed Partners. Rich, you watch Netflix probably closer than anybody out there in terms of analysis. What happened here? Do you think that this is also partially that the company did not prepare people well enough for this kind of a disappointment?
Well, I mean, I think what's sort of interesting, right, is you're seeing the stock down, over 20%. You're seeing most of Wall Street just throw in the towel and downgrade the stock and say, instead of this thing being worth 700 or whatnot, it's now only worth 400. And look, I think the reality is we're still very early in the streaming conversion from linear TV to streaming television. It's hard to believe that with 220 odd million subscribers that we're, that's the ceiling, or that 250 million is the ceiling. Broadband is in, you're talking about there's probably 600, 700, 800 million homes with high enough quality broadband to, support Netflix streaming or any streaming service. But let's step back. In the last quarter, they added 8.3 million subscribers, and they're telling you, even with a price increase in their largest market, they're going to add another 2.5 this quarter. So in Q4 and Q1 alone, they've added, essentially 11 million subscribers. This company is not, this is not over. I think, is it a straight line? No. I mean, I followed Netflix for, a long time now. There has never been a simple answer to why they miss. I remember you can go back in time and they were talking about the chips in credit cards they were struggling with. Like, they were sort of making up excuses for why they missed numbers or missed growth expectations in the past. I think they were pretty honest. They don't exactly know all of the pieces. I think what we do know is that Netflix takes more shots on goal than anyone else. You saw that with Squid Game. Nobody had Squid Game as the breakout hit that was going to fuel Q4 a year ago. But yet that's exactly what happened in Q4. Was Squid Game was a huge tailwind. So you don't know what's going to drive Netflix. They take a lot of shots on goal. And my guess is something's going to happen over the course of the next 11 months that's going to surprise people because of the amount of shots on goal that they're taking. No one's giving them credit for that today. Everyone's just throwing in the towel, trying to extrapolate out of one quarter of disappointing numbers relative to looking at the big picture and going, they have 33 million subs in all of Asia Pacific ex-China. That number can be 300 million over time. There's still lots of growth to go. Unfortunately, and this is what the market has to deal with, it isn't always the pretty straight line that the market would like.
Rich, is one of the reads off of this quarter, though, that just given the market reaction and just the mood on the street after this Does Netflix have to take even more shots? Do they need to go out there and buy a gaming publisher? Do they need to even invest even more in original content on top of really the large sums they are investing in?
Well, certainly that's, I think the statement you just made is certainly why the rest of the group is suffering. That's why Disney's down. That's why Viacom's down. That's why Discovery's down. There is certainly a fear that, heck, if Netflix doesn't have enough content to continue to grow subscribers, imagine what everyone else has to do. They're spending far, far less than Netflix. So it just sort of speaks to how hard streaming is, not just in content, but in tech spending, et cetera. But I think the answer to Netflix is they are spending more. I mean, I think that's the thing that investors should be looking at and taking this as an opportunity to buy more versus to sell, is that Netflix is not telling you they're cutting spending. If Netflix was telling you, look, it doesn't make sense to spend more money. There's no more subs. We've reached that ceiling, that streaming wars ceiling of like 220 or 250 million, like there is no more subs to get. That would be a really negative sign that Netflix has gone X growth and it's over. Instead, what they're telling you is it's early. We don't fully understand why we're not growing faster right now. We're investing more in content all around the world, and we are confident that over the long term, there is still a massive, total addressable market, their TAM of hundreds and hundreds of millions of subscribers to capture. So I think they're actually very confident in the next several years. I think it's Wall Street that has no confidence in that and is just worried that this growth story is over.
To sort of pick up on one small thing, though, that Sazi was asking about, and that's gaming. The company did introduce mobile gaming during the quarter. Now, I don't know what the numbers are looking like, and I don't know so I guess what I'm asking is, even if the total addressable market is enormous, there's also on top of that another enormous market that's a different one for something like gaming. And is that
and look what's happened look what's happened in the last week. I mean, I'm sure you've been talking actively about Microsoft and Activision and about Take-Two and Zynga, right?
Yes.
There is clearly tremendous interest in the power of mobile gaming, or just video gaming in general. My partner at Lightshed, Brandon Ross, has been very outspoken of sort of the biggest growth vector coming out of the pandemic is obviously what's happened in video gaming. And it's been a huge tailwind to Epic and Roblox and all of these companies in the gaming space, especially ones that participate on the mobile end. But I think for Netflix, the reality is they recognize the importance of gaming. They're not sitting around simply relying purely on entertainment. And I think they've correctly understood. They knew they had to move into original programming. They knew they had to go global. They knew they had to do global original programming. And now they're looking at, okay, we have a base of 220 million subscribers. How do we give them more to do that will allow us to tap into more time spent and ultimately be able to drive price even further? I mean, that's why they're able to drive price up 11% in the US, is that they have so much time spent on connected TVs. People can't live without Netflix. We can debate how fast they're going to grow, but people can't give it up. This is not a churn problem that Netflix is facing. And so I think gaming is a natural extension of that, is how do we capture more time per day? And go back to your question about other companies. Nobody else is entering gaming. You're not seeing any of these other streaming platforms push on gaming. And so I think this is a unique opportunity where Netflix is trying to get out ahead of everyone else yet again. They're so far ahead in original programming overseas. Now they're entering gaming. No one else is there. I think it's a pretty interesting opportunity to give people more to do on the platform and leverage their franchises, the content they're creating, and figure out how they make games that tie to that. I think it makes a tremendous amount of sense. It's very early, but they talked about last night how they are seeing good engagement across their user base with this content. And remember, Netflix on mobile was not a heavily used product. Everyone has Netflix on their phone, but it doesn't get used. Most Netflix viewing is on a big screen or a laptop. And so this is a way to meaningfully increase time spent on the most personal device in your life, the mobile phone, where video viewing happens, but long form viewing just doesn't happen as much. So I think it's a really interesting play by Netflix. But again, this is sort of, you're probably in the top of the first for their video game strategy.
Do they buy a publisher to speed things along?
Well, they bought a small publisher. I wouldn't be surprised to see them buy other small publishers. If you look at sort of the entertainment or the video content side of Netflix, They've never gone out and bought a big studio. They've basically went out and hired the best talent, which is something they're clearly doing on the gaming side. They're trying to hire great talent. And then on top of that, they are certainly looking for smaller tuck-ins, like they bought the Ronald Dahl estate. Like you look at what they've done in video content. I think they're going to do the same thing on the gaming side, meaning lots of smaller tuck-in unique acquisitions, and then go out and just try to hire and invest in the best talent they can possibly get.
Rich,
and when you're spending $18 billion on content, to put 5% of that spend into gaming, that's a big number for the gaming space. But in the terms of the totality of Netflix's content spend, it's actually a relatively small number. So it's possible to invest in gaming, even in a pretty meaningful way as part of their overall spend.
Now, Rich, I want to be a chat with you without something on AMC. Now, what Netflix said on their call, perhaps there's a COVID hangover, perhaps people are getting more mobile again. Does the quarter off in Netflix suggest AMC might be a good buy here ahead of the spring and summer?
I mean, I think AMC is in a very, very difficult position. I mean, I don't know if you've looked at box office numbers year to date, but I think, last year obviously ended with the huge success of Spider-Man, but box office was still, down almost 30% in Q4. But what's scary and what should be panicking every investor who owns AMC stock is box office is down over 50% from 2020, from 2019, 2018. The beginning of this year is just an absolute disaster. Like people are just, the movies that are coming out are not generating a lot of box office, and people clearly are not showing up to theaters. And you're even seeing studios like Disney take their next big Pixar movie and send it directly to Disney Plus. And so the trend of companies avoiding the theaters is continuing. And you've got the CEO of AMC selling every vested share he possibly has. And so I think it's a pretty clear sign that the movie theater business is not fixed. If anything, you're seeing an increasing trend where a few movies a year will be huge. Batman in March will be huge for Warner Brothers, but very few films are going to require a visit to the movie theater. And so you're probably looking at it in our top 20 for 22. We talked about our prediction of, we think box office this year is $8.5 to $9 billion compared to $11.3 billion in 2019. So that's a pretty dire forecast for box office and for AMC. So we would be continuing to sell AMC here.
Brian Sozzi, just couldn't resist asking you about that one.
Yeah, do it.
Rich Greenfield, partner and media and tech analyst at Lightshed Partners. Rich, it is always really great to get your perspective on all of these issues. Appreciate your time. Have a great weekend.
Yeah, let's break down these results further with our first guest for the hour. We've got Michael Pachter, Wedbush Securities Managing Director, Equity Research. Michael, this stock, specifically Netflix, has been a darling during the pandemic, and there's been a lot of concern. Yes, they had a lot of momentum over the last 2 years. Was there a lot of pull forward? What do you make of the stock reaction?
I think it's appropriate. And, as much as I respect Reed Hastings' intellect, he's just not a stupid man. He was incredibly disingenuous in that clip you just showed, because he ignored the three things that are driving the share price down. One is that Netflix is a lot bigger than they were, in the last 12 years, and they're approaching market saturation, particularly in high GDP countries. Second is the competition from Hulu and Amazon Prime was maybe 50 million subscribers, 5 years ago. It's over 200 million now between HBO Max and Peacock and Hulu and Paramount Plus and Disney Plus. So subscribers are peeling off. And then the third thing, which really matters, is each of these services is keeping its own content exclusive to its own platform. So Netflix used to have Disney content, not just a couple of years ago. No more. No Disney, no Fox, no NBC Universal, no Paramount, Viacom, CBS. So the idea that Netflix can keep growing without the content it historically has had access to in a market that is fragmented and chasing the same wallets, and with Netflix already penetrated in all above median income households in the West, it was inevitable they were going to stop growing. I've been wrong for 10 years. I'm going to take my victory lap now. I'm right finally after 10 years of downgrade.
Michael, would love to know what kind of spend profile you think that this enters Netflix into. As you mentioned on the content side, this means that if there is that risk of content rolling off so that some of those other platforms can continue to take some of that back and the equity that comes along with those titles, where that means Netflix is going to have to continue to lean in to try and create the next Stranger Things, or just continue to create some of the popular series, Ozark, Bridgerton, and what you may have there.
Well, clearly, everybody's competing for the same content. Netflix has done a great job with owned originals, Ozark not being one of them, coming out today, by the way. That's owned by Media Rights Capital. Bridgerton is owned, but they're paying Shonda Rhimes something like $300 million to produce that. So it's highly likely that is an unprofitable series. They have to keep finding the Squid Games, and they're doing a great job. They really are. I think their original content's great. I think their licensed content's great. The problem is they're probably 75% licensed still, and each licensed property has to be renewed every year. So Ozark, season 4 coming out tonight, I guess it's already out. They have to pay for seasons 1, 2, and 3 again. And HBO doesn't have that problem. All their shows are original. And Disney, same. So I think Netflix's cost disadvantage in competing for a shrinking pool of independent content is bad. I don't think they're really any better than Disney or Warner Brothers at making original content. And in fact, HBO content is significantly better, at least on Metacritic terms. So, I think it's just a tough road. I think these guys are battling behemoths who are better at producing content than they are.
Michael, as you noted, you've got an underperform rating on the stock. When you think about the moves today, we're getting closer to that 12-month price target you have of $342 a share. What would it take for you to change that rating? What do you want to see?
Oh, I mean, my target's sincere. So if the stock gets to, and I think our rules here are within 10%. So it literally could drop another $10 or so, and I have the right to upgrade. I actually want to see probably one more quarter, but if the stock melts down and goes to 250, of course I would upgrade. I don't know how permanent this is. There are a lot of people, cult members who have drunk the Kool-Aid, and they decide they just love Netflix at any price. So my guess is it'll probably rebound as soon as the market turns green, and probably go back to 450. And I have no interest in raising my price target until I see what their growth profile and their cash profile is.
And considering that cash and the spend that's necessarily, as we were mentioning a moment ago, on that licensing and even on the production side, where does this set up for one of the other major categories for Netflix too, that at least we've thought they would do better about getting into, and that's on the gaming front, yet we still don't have a ton to go off of there. What are you going to be watching for most closely as we continue to see what types of breadcrumbs they give us on gaming and their ambitions therein?
I really am watching for how many years it takes before they give up and write the whole thing off. Disney tried to do gaming 3 different times in the last 20 years and shut it down 3 times. The only media company that's been successful in gaming is Warner Brothers. And of course, they got purchased by AT&T, and that unit is rumored to be for sale. It's hard. Gaming is really hard. And Netflix isn't going about it right. The guy they hired is an accomplished video game guy, but he last produced a game 20 years ago. And, I haven't seen him cobbling together a team that's going to turn out quality content. So I think they're chasing this the wrong way. I think they should have been involved in buying Zynga. I think they should have been involved in buying Activision, and they just don't seem to have any interest. They don't want to make a big statement. They want to grow slowly. I'm confident they will grow really, really slowly. So the question is just, when do they realize that they can't get there and they have to give up?
You just mentioned 2 names that Microsoft has now gone after. Can't let you go without asking about the big deal this week of Microsoft acquiring Activision Blizzard. As somebody who's been following the gaming space, how big of a shift does this represent? Look
at that Activision share price, $81. That's the risk arbs telling you that they have low confidence that this deal will be approved by regulators at 95. So you're getting a 15% discount on a deal that's likely to close within a year. That's a pretty good return. And Microsoft was out with a tweet yesterday saying they're going to support the PlayStation platform and that Call of Duty will be on the PlayStation. That's preemptive. That's to tell regulators we're not trying to put Sony out of business. Think of Microsoft buying Activision the same way you would think of Disney buying, Fox. They want more content for the streaming service, and they can keep it off Netflix by doing so. So Microsoft wants more content for Game Pass, and by buying Activision Blizzard, they keep it off of the upcoming Sony streaming platform. That's smart. It's legal, and regulators aren't going to block that as long as they continue to support the platforms that Activision supported in the past. So I think this is a great combination. I'm disappointed to see it happen because it takes one of my favorite stocks out of my coverage universe. But it's actually the right thing for Microsoft to do. And Activision gets all of its sexual harassment issues behind it pretty quickly.
Michael, always good to get your take here. Michael Pachter, Wedbush Securities Managing Director of Equity Research.